In the previous section, we learned that title insurance protects against past defects that could affect property ownership. Now let's look closer at the two major types of title insurance used in Arizona real estate transactions: the owner's policy and the lender's policy. Although both are issued by the same title company, often at the same closing, they protect different interests and remain active for different timeframes. Understanding how each works helps agents explain coverage to clients and anticipate questions that often arise during escrow. The owner's policy. An owner's policy of title insurance protects the buyer's legal ownership or equity in the property. It is issued for the full purchase price and remains in effect for as long as the buyer holds title. Once the property closes, this policy becomes the buyer's safety net. If a hidden title problem is discovered later, something that existed prior to closing but wasn't listed in the title report, the title insurer will defend the owner's rights or reimburse for covered losses. Common examples of covered claims include a forged deed in a previous transaction, an undisclosed heir claiming ownership after a relative's death, a recording error that omits a previous release or lien, a boundary discrepancy from an outdated legal description. For instance, in Pima County, a buyer of a historic Tucson home discovered months after closing that an old mechanic's lien from a 1998 renovation had never been released. Because the issue predated the policy, the title insurer paid to resolve the lien and remove it from record, protecting the buyer's ownership. In Arizona, owners' policies are standardized through the American Land Title Association, ALTA, and regulated by the Arizona Department of Insurance and Financial Institutions, DIFI, under ARS, paragraph 20-1562 ETSEQ. The policy insures against losses up to the purchase price, plus legal defense costs, if ownership must be defended in court. The lender's policy, a lender's policy, sometimes called a loan policy, protects the mortgage lender's security interest, not the buyer's equity. It ensures the lender has a valid and enforceable first lien against the property. Coverage equals the loan amount and decreases as the loan is repaid. The policy automatically terminates when the loan is paid in full or refinanced. Example: a buyer in Gilbert purchases a home with a conventional loan. Months after closing, a previously unrecorded judgment is filed against the seller that predates the sale. Because the lender's policy guarantees the lender's lien priority, the title company clears the issue to protect the bank's position. Most lenders will not fund a mortgage without this policy. It is required by secondary market investors such as Fannie Mae and Freddie Mac, and it ensures that no prior liens could jeopardize repayment security. Comparing coverage feature owner's policy lender's policy, who is insured buyer or property owner, mortgage lender. Coverage amount, purchase price, loan amount, duration. For as long as the owner holds title until loan is repaid or refinanced. Purpose, protects ownership interest. Protects lender's lien position issued to buyer lender, paid by typically the seller in Arizona, negotiable, buyer-borrower, regulated by DIFI, ARS, paragraph 10-1561, ECQ, DIFI, same statutes. Both policies are typically issued together at closing. The title company conducts one search and then issues the two policies simultaneously, often at a reduced simultaneous issue rate approved by DIFI under ARS paragraph 2376, coverage interaction. Although both policies stem from the same title commitment, they operate independently. If a claim arises, the insurer handles each according to the insured party's interest. For example, a lender's claim may relate to lien priority, while an owner's claim may relate to outright ownership. Example: a homeowner in Queen Creek discovered after closing that a small portion of the backyard was subject to an unrecorded easement. The lender's policy had no exposure, the loan was still secured, but the owner's policy provided coverage for the lost use of that section of land. When coverage ends or transfers, an owner's policy ends when the insured conveys the property to someone else. unless the deed transfers title to a living trust or spouse. Arizona's ARS, paragraph 33 to 431, recognizes survivorship and trust interests, and most modern ALTA policies automatically continue coverage for such transfers. A lender's policy ends once the debt is satisfied or the loan is refinanced. When refinancing, a new lender's policy must be issued based on the updated loan amount and current title search. Agent's responsibility under Commissioner's Rule R428-101A. Agents must protect their clients' interests by ensuring that the appropriate policies are ordered and issued at closing. Agents should explain that these two policies serve different purposes, even though they are often issued together. If a client questions why both are needed, a simple explanation helps. Your lender wants to protect the amount loaned, but your owner's policy protects your ownership rights. Both are important, but only one belongs to you. Clear communication avoids confusion and demonstrates professionalism in compliance with R428-1101E, which requires accurate disclosure of material information in a transaction. Key takeaways. An owner's policy protects the buyer's ownership rights, while a lender's policy protects the lender's security interest. Both are regulated by DFI and governed by ARS Title 20. They are typically issued together at closing for a one-time premium. Agents should confirm that both policies are ordered, explain their differences, and ensure clients understand that one policy does not replace the other.